Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending October 7th, 2022. I'm President Brent. Thanks for tuning in. Well, this week's theme is good news is bad news. We're back to that again. The markets really started off this week in a great positive note. I mean, it was very strong. I want to just kind of go through how the week started and then why we ended up where we did. The first 2 days, Monday and Tuesday, bouncing off almost record 2-year lows. The S&P rose 5.6%. The other indexes were up, also very strong. Biggest 2-day move in the S&P since 2020 and the third best to the start of October since 1930. Yet the way we ended the week was very depressing for the bulls anyway. It didn't seem like we finished the week in the green, but we did. Thursday and Friday, especially Friday, was a very bad day. You can see, looking at the index performance, everything was in the green for the week. Year to date, we're still in bear market territory, except for the Dow. It just barely clawed right out of being down 20%, but you could probably assume it's in a bear market territory. Okay. Just very ugly. Now, what caused the markets to reverse course going through the end of the week? Well, it started on Wednesday when OPEC announced their 2 million barrel per day cut target production. And I know some oil analysts are saying, well, it really isn't 2 million. It's slightly under a million because some OPEC countries aren't meeting their quotas anyway. But either way, it's still a very substantial rate cut, as evidenced by the huge move up in oil. You can see this past week, energy was up 13.5% for the week. Year to date, it's up over 52%. So either way, it affected the markets. And obviously, that started the tilt towards, okay, higher oil means higher gas prices. Higher gas prices means more inflation. So that reversed the huge 5.6% gain in the S&P and some of the other indexes, and we started to move lower. Then we get the jobs report on Thursday and the JOLTS report. But then what really downfalled the markets this week was the jobs report, the big monthly number coming in Friday. We added 263,000 jobs in September, but the unemployment rate actually fell to multi-year lows of 3.5% from 3.7. So that sent price action down hard. Everybody was down going in as we rounded out the end of this week. Now, we did finish the week, as I said, in gains, as you can see there, but it didn't seem that way, right? For the bulls, it seemed like it was a very depressing week to start off so strong and then give up over 85% of the gains that you made in the first part of the week, right? Now, the ISM came in and it fell to 50.9 in September. Remember, under 50 indicates contraction. So it came in below consensus expectations. It's the lowest level the ISM has been since 2020. So at least we're seeing the effect of higher rates starting to take effect, okay? Treasury yields also increased Friday morning after the non-farms payroll data, reversing earlier declines in the week, and some of the positive sentiment that the markets had earlier in the week, right? Now, the Feds are going to be meeting the first week in November, but we're getting key data out this week. One of them is going to be the CPI data on Thursday. The current Fed funds rate is 3 to 3.25%, but the odds favor a 75 basis point rate hike in early November and then a 50 basis point rate hike in December, getting a year-end target rate of a little over 4.4, 4.5 or 6%. That's kind of what we're looking at right now. Okay. So all in all, the markets, even though in the green, just did not seem that way. You can see the PE ratio, the forward PE ratio, also with earnings starting off this week, have been reduced. Valuations are coming down. The forward PE is 16.3. You can see the dividend yield in the 10-year Treasury is about over 209 basis points higher than the dividend yield. Earnings yield still is relatively strong, but that 228 number, which is the earnings per share estimate on a go forward basis, is probably going to fall, and that's going to reduce the earnings yield. Okay. you can see the S&P yield over the 10-year Treasury, but the real yield is a negative over 2%. So that just shows high inflation is just killing everything. Okay. I mean, it's knocking everything around is what it's doing. Now, the other thing is the current VIX was down. It was almost, let's just call it flat. The prior week it finished at 31.62. This week it finished at 31.36. So, and I know some analysts are calling for capitulation where the VIX moves over 30 to 40 or 45. I don't see that unless there's some surprise in the market. All we're getting is an early move lower with valuation reset. That's all it is, guys. You're not going to get that capitulation in that. Remember, when you shut the economy down and then you turn it back on, unintended consequences happen. We've never done that before. So I think sometimes going back and looking at history that would define a bear market. I just don't know if history is a precedent for what we did in 2020. So I can see the VIX maybe doing a day or two spike up to 35, 36, but I just don't see the 40 to 45 spike. Not unless we get some very strange news coming out of Russia, Ukraine, or we get some other unintended consequence, like what they had over in Great Britain with the UK when they started to have their market seize up and the UK had to reverse course on some of their fiscal policies over there. So anyway, that's what I'm seeing right now in the U.S. markets. You can see the best performer for the week, obviously energy, as I said. The worst is real estate. I think real estate's going to continue to go down as rates continue to march higher. It's just not going to be very pretty. Okay. Now, if we go over to Europe, let's just take a look over first at Europe. You can see everybody there was in the green too. Most of this was a bounce. Remember, we had 4 weeks in a row of losses. So we finally, this past week, finished up, and you could probably call it a dead cat bounce. You can call it a bear market rally. I'm still projecting we're going to move a little bit lower. I'll show you the charts in a minute. But over there, the ECB has still got a very tight monetary policy. They're looking at being very aggressive. Inflation over there is higher, slightly higher than it is here in the U.S. Their producer price index in August came in higher than they expected. So they're having major problems with inflation over in Europe. So, and on top of that, of course, they've got their energy crisis with Russia and just how that's going to pan itself out. So people are pissed over there, right? We're also seeing weaker than expected industrial output and retail sales in Germany. And Germany's kind of the linchpin that make up the countries of the ECB, the 19 countries that make it up. So Germany's faltering, and when they start to falter, it just gets uglier quicker. Okay. Now, if we slide on over to the Asian markets, you can see in Asia, the Nikkei, the Japanese market, China was flat because they're in a holiday period. They've got their national holiday. But if we look at Japan for a second, they had solid gains, very strong week for the Nikkei. The yen actually rallied in the middle of the week, and it gave up some of its rally against the dollar. But it closed out the week around 144, I guess. Consumer price indexes, CPI in Tokyo, also came up to 2.8%, which is rare for them to have any signs of inflation. That's the biggest gain they've had since 2014. But we're also seeing in Japan, households are cutting back on their consumer spending there. But that's the second month in a row for that. And their services sector climbed finally into expansionary territory. It moved up to 52.2 from 49.5 in August. So that is showing some sense of life there. But Japan is really not a true capital market. I mean, the Bank of Japan pretty much runs that economy. They own about 70, 80% of all ETFs. They control about 80 or 90% of all the debt over there. Consumers just aren't in the markets like the Japanese are. So it's a rigged market in my mind over there. And then, of course, if we look at China, they've been shut down this whole past week from October 1st to 7th. They're opening it up this weekend. They called it their national holiday, Golden Week, I think is what they call it. I wish we had holidays like that. When we shut down, it's a half a day here or one day there, and traders force a half day, but it's still open, the markets, right? But over in China, they'll shut down for a week here and a week there. So that means the opening gap when they finally open up is pretty big. But anyway, they shut down for the week, so nothing's going on over there. The only news of late coming out of Beijing is they got their Chinese Communist Party Congress. It meets twice a decade, so once every 5 years, right? And they're slated to elect President Xi. It's going to be an unprecedented third term. He wants to get it for life, so we'll see how that goes. So he's not going to do anything until we come out of that, but we will get some good information on what he wants to do with China. I think they want to continue to just press on the way they're going right now. So that's a little bit about what I'm seeing in the markets globally. We're still in a bear market. We got bear market charts. Let me just switch the screen here. I'm going to get you over to a chart of the S&P 500 E-mini futures. Let's get it over here like this. And I'll show you the target that I've got. I actually raised the target just a little bit. I had the S&P targeted at 3,200. Now, this is before the end of the year, but it's before the end of the year. And you can see here that it's sitting right at around 3,500, all right? And I'll step out a little bit and give you a weekly view also, but you can see here it's about 3,500. We hit our low for the year on October 2nd. The S&P was down about 25.36%. You can see the Monday and Tuesday rally, right here. Let me just widen it out a little bit so you can see a little bit better. You can see here that we moved up very strong right here Monday and Tuesday, and then we gave up about 75% of the gain here. And then we're centering back in on some support points here. I do see moving down into this area here. And I told our members, I give it a range of 34 to 3,500. This range right here, if we move down here, it would give up almost all the gains we made post-COVID, okay? And what I mean by that, let me show you another chart that will probably lay it out just a little bit better. Well, that's not the one I want. Let's go to this one right here. All right, this is a weekly chart. And you can see over here on the left, that was the COVID low back on March 23rd, 2020. This is the post-COVID pivot high made early January 3rd. We're at 4808.25 for the highs in the S&P E-mini futures. And you can see this rollover right here. Now, this is a weekly chart. And you can see on this weekly chart how we had a symmetrical triangle here, which we broke here. And you can see this shaded zone right here. The bottom of the shaded zone is right at the peak before we gave it all up at COVID. And you can see here, this is my target. Now that colored bar is a combination, it's system generated. I could draw it on the screen, but I don't like all the lines on the screen. But it's system generated. What it does is it takes an estimated Elliott wave 5 with a combination of Gann and Fibonacci extensions to calculate an Elliott wave 5 down. Now, even though that's an ABC pattern, it's projecting it. Notice it's projecting it almost right in the center of this shaded zone here, okay? So this is where I'm looking at finding firm support. I do not believe we will go lower than that. But going down to this area here, you'll see headlines such to the effect that it says markets have given up all post-COVID profits. And we're right back to where we started back in February 17th, 18th of 2020, okay? So that's kind of what I'm looking at here. And then we're going to find some firm bounce. And then I think we could see some movement higher through November into December. And then it's going to start to get ugly again back in Q1, Q2 of next year as earnings really start to come down even more. The effect of all this higher interest rate, layoffs that are coming in the jobs market. And remember, there's a 6 to 9 month lag in all this. And then we're going to get a little bit more of a move lower, okay? So that's a little bit about what I'm seeing right now in this market, okay? And if we come over here, and this is the E-mini S&P 500 futures, but all the other indexes look exactly alike, okay? They look just the same. So there's really no need to review those trades. But what I want to do is come down here and take a look at volatility. I do not see a vol spike. I do see our capitulation. It's going to be a gradual kind of thing. This is a daily chart of the VIX. And if I move it out to include the entire year, right here, this is the entire year. Look at this. We haven't been over, we've only had one close above 36.47 all year long. And we're down 25%, okay, roughly in the S&P. And you can see that we get up into the red zone and then it pulls right back again. The last time we actually had a pretty good little spike, okay, was over here, but even then, not over 40. We spiked here back in 2020. That was post-COVID, all right? But the last time we really spiked was here in COVID, and that's when we moved back up over 40. And that was during this 2 or 3 month period, and then post-COVID by just a couple of months for fear of rolling back over again. But outside of that, we haven't been there, okay? And the last big spike we had, take COVID out of the picture, was Volmageddon back in December 2018 into 2019, and even it only spiked up to about 38 or 39. So what's happening here is we're holding a very high VIX rate, and it's very difficult to hold it this high. But the reason why it is it's probably going to be volatility is going to remain bid, meaning people want to buy it coming up to the Fed policy on November 2nd, and when we get an idea what the Feds are going to do. Okay, so we're going to see the VIX stay arbitrarily higher than normal until we get a little bit more clarity on the Fed. And then it may just kind of drift down like this as we start going down. It's not going to crash down. I don't see a crash up. I see more of an orderly side, even though it's a lot higher, again, more orderly. And of course, if we look at the bond market, you can see here in bonds, we're down 23 ticks. My target for bonds was around 121.25. You can see that area here. We don't need this one up here anymore, so I can just get rid of that one. So this is my target. You can see my other prior target over here that was made in the summer months. We hit, went briefly below it, and this is kind of where we're sitting here. And of course, if we come in and look at the 10-year rate, I've got a target rate for the 10-year that we pretty much come close to hitting, all right? And the Elliott wave is suggesting that the target rate can move all the way up to 4.8. And that's believable because remember the Fed funds rate is forecast to hit about 4.5, 4.6 by the summer of next year. Now that's the short-term Fed fund rate. But I think it's going to be harder to get the 10-year up there, but I think it'll eventually go. Some people estimate that the breaking point for the equities where it'll really go down even harder is if the 10-year gets over 4.5%. But we're certainly moving up back to my my original target rate, which was a little over 4%. Okay, so and then if we come over here to currencies, if we look at the dollar is always on fire. You can see the dollar here bounced off my original target rate. I think we'll move up here, but I think it's going to roll back over again. I think the short of all time is going to be the US dollar, or the long of all time is going to be the euro or the pound, but not right now. When that thing triggers, it's going to go. Like if we look at the euro, and there are a number of different ways to trade the euro. You can see all these targets that we blow through and move up and run into resistance, blow through, run up, run into resistance. It's the same pattern. And every time we get over the 50 EMA, up to the 50 EMA, it rolls back over. You can see the red lines of 50 EMA. It just cannot get over. And I'm going back in time here, right? Over here, same thing over here. The last time we held the 50 EMA, but that was just for a week, was in February of this year. And outside of that, and even then, we couldn't hold it very long, right? Look at this. The last time we were actually, and let me just squeeze this out a little bit. The last time we held a 50 EMA for any given period of time was in April of 2021. And even then, the euro is at 121. It's just been moving lower and lower and lower, right? And this is a bear market chart. So you have to make the assumption that until you're proven wrong, otherwise this thing is going to continue to go sideways to down. You can see the 200 EMA is way up here. So eventually it's going to run back up. It's going to be a great trending run, but we got to get above the 50 EMA. And once that happens for our members, we've got some interesting trades that we can put on in the option market and Euro futures. If you don't want to trade the options market, you can trade FXE, which is the ETF that tracks Euro. It's going to be a great trade. And of course, if we look at gold, I'm not bullish gold. I want to stand down in gold. You can see where it just cannot. One day over the 50 EMA, it rolled back. My target for gold was 1606. We actually hit 1622. So that's close enough for my target. I think this will come back a little bit, settle in. I want to go long gold, but I need to see a little bit better price action than this to want to do it. And of course, if we look at copper, well, copper is a global economy type barometer. And my target for copper over here is in the November, December timeframe down in this level down here, right? And you can see, like the euro, it just cannot get over that to the 50 EMA. And it's a bear market chart. So the odds favor more downside for copper as well, okay? And then finally, if we look at oil in the energy market, you can see oil had a very strong update. Look at this. I mean, this is just the coming OPEC meeting. You could see it going up in anticipation because OPEC broadcast what they wanted to do, but then they actually did it, and then it just took off. Okay. The 50 crossed the 200 to the downside, but you want to be neutral to bullish in oil. I think it can run back up over 100. And then we're going to kind of stay stuck in that 90 to 110 range for a while. Okay. Nat gas. Well, nat gas is very choppy. As you can see around the 200 EMA, up here was when I had made the call to short nat gas. Okay. Now we've been long nat gas all summer long, playing it with Europe. Made nice money on it, got out at the top, and I said pick up some puts in this thing. Same thing over here. Nat gas has a hard time maintaining north of 8 or 9 in the futures world. So that was just a trade that many of our members made some really good money on that. All right, everybody, there's a lot of other activity going on. Members, I will review that as well as these charts in a little bit more detail in our weekly market watch this coming Sunday at 8 p.m. Eastern Standard Time. Everybody have a great weekend. Members, I'll see you Sunday evening. Take care, folks.